Hi, Diana.
Hey.
Just waiting for other people to join, so.
Thank you.
Hi, Lauren.
Hey Anton, sorry, I thought I was muted. Hopefully you didn't hear my dog.
You're fine. You're good.
How are you doing?
Good. I'm just waiting another minute or so and I'll get started, but happy Friday to everybody.
Happy Friday to you too. I tend to only get the end of your call. I'm so glad to be able to see the whole
Yeah,
thing.
You're fine. All right. Well, I'm ready to go. So let's get started. And this is recorded for anybody else that wants to watch it later. So happy holiday weekend. So hopefully we'll dodge some raindrops at some point this month. All right. So the August numbers are in, and just moving something out of my screen. Can you see my screen, my market monitor screen?
Yes, I can see it.
Okay. So here we go. This is everything. So this is, again, market monitor, everything in MLS, median sales price. So notice year over year, we're up 11.4%. But look what's happened the last couple months. So in May, we were 425. June, we were 420. July, we were 399. We're basically the same 399. So it's very interesting. If you look at for Charleston, and again, Charleston generally reflects what's happening in the US as a whole, but from January to May, we went from 360 to 425 in 5 months. That's 18% in 5 months, right? That's unsustainable in any world. So again, the downward trend here is not shocking for a couple reasons. One is you can't keep up this pace. Two is if you look historically, the second half of the year is never like the first half in appreciation. And I'm just going to take you back to the first, if we're going to call it normal year in real estate. Going back in time was probably 2019. So look in 2019, we were at 266 in January. And if we go to June, we hit 290. But look what happens from June onward is you kind of have some little bit up and down, but towards the end of the year, it's a downward trend, right? So June was 289, December was 275. Did house prices go down by 15,000 that year? You know, it's one of those things, the dynamics of the Charleston market, the first 6 months of the year is where you see most of your appreciation. And typically the second 6 months is more of a sideways, maybe slightly down type of movement. So this is a very normal year. Now, overall, if you look at January of 2020 was 287, January of 2019 was 266. So again, when you compare January to January, it was up, but you have this seasonality even on the prices. And this is a very quick run up. And this is kind of readjustment, you know, kind of an overshoot, if you want to call it that. That was too aggressive. And we're kind of working backwards. Interest rates are an influence, more inventory, less buyers, all of that happens. But a lot of those factors, you know, the higher number of the lower demand in the second half of the year is not abnormal. You know, that is the typical Charleston market. And if you go back in time prior to 19, it looks like that as well. So I guess what I'm saying is you can see this is slowing down year over year, which is, again, probably needed long term because we cannot sustain this type of clip. Now, what's going to be interesting is that the way the media perceives everything, if you read their articles, oh, look, year over year prices are still up, you know, month over month are kind of going down. What's going to be interesting, I think, is when you hit next May, the May of 2023, when we hit that time period, I would say it's probably highly unlikely that the Charleston prices will see a year over year increase May 2023 compared to May 2022.
Muted. No, I was.
So by June, what's going to happen in June is that all of a sudden the media is going to say, oh, look at the May numbers. House prices are down 5%, right? Because I just don't see where May of 2023 will be above 425. So again, it's going to be a year over year driven media frenzy next June. and this is something to watch for going forward, is that we just need to be able to explain to clients what the media is saying. So watch that going forward. Now, again, we could see a little bit lower trend towards the end of the year. I think this number will still stay positive until we start to hit the spring of next year. So, just watch that long term, but this pace is unsustainable. And if we go back in time, so look at the rise, and especially right in here, look at the slope of that. And especially if we go back, if I get rid of the monthly to get rid of the seasonality part of it, and I go rolling 12 months. So look, and this goes back all the way to 2004, right? So we had the rise pre-recession, recession period, and then a very steady, look how straight this line looks, a very steady rise in prices. And this is roughly, just to use an easy number, about 5% increase. So this type of slope is a 5% increase. This type of slope is unsustainable long-term. And you can see right at the tip here, we're starting to kind of level back out. But what I see is, we're not, you're not going to see this type of fall, but it can't keep going at this type of slope either. It's going to return to this 5% level. And if we go back to the monthly, and I'll zoom in a little bit again. So if I go back 3 years, again, this slope will slow down, but yes, there's probably a few houses that people probably overpaid for in here based off the low supply. But overall, the market should still be healthy. What's interesting is you look at price per square foot is actually up 18%. So it still was higher, and August is the highest number. So, and I think a lot of this has to do with all the renovation happening, right? If somebody buys a house for $250 and they put a lot of money into it and they sell it for $400, that same house price per square foot just jumped. So I think a lot of this increase continual is due to all the upgrades happening on homes. I mean, I know up and down my street, I see all the contractors out there. And I think that's part of why this price per square foot is higher. If you look at percent of original price, again, so half the houses are selling for 100 or higher, half below that. But if you look at the average, so look at and again, median is where the middle point is. Average is, we were at 101.2% in May. So when were those contracts written? Those were probably March, April contracts, right? Now we're down to 98.2. So we've lost 3% on the average. And this is from original list price. So all those price changes we're seeing, it's reflected on here, right? This is where that is being reflected. We've dropped 3% in just a few months. So 98.2 is where we're at right now. So where this is going, I mean, you still see price changes. I mean, I think sellers over time will become more realistic on where they need to list and not overprice, assuming this market was never going to end. So this will adjust at some point. And again, if we go back in time, you can see for many years, I mean, if we look at 2014 to 2019 or so, we were bouncing between 95 and 97.5%. So, 96, 97, that's pretty normal. And you can even see the seasonality within each year. So look at how high we got, in this area here. So we're at 98.2. I expect we're going to end up back in here. This is a normal market. So I expect this number, we're going to end up back in that 96% range. So there will be negotiability, and there is negotiability now in some cases. You still have multiple offers. I'm not saying that doesn't exist, but not to the level it was in the spring. Let's zoom in again. So days on market. So here's our days on market. So, we're sitting here, this is median, right? So median in the spring, 3 days on market. So half the houses were selling in 3 days or less, right? Everybody would list, and then we'd sell over the weekend, and everybody was happy, right? Except for the buyers who didn't get the house. So here we're at 3 or 4. So look at the last month, we've gone from 4 to 7. 7 is still unbelievably low, but that trend is changing. And if we go back in time, you can see that normal range. And again, there's still seasonality involved, right? The winter is slower. spring gets really fast, winter slower. You can see that seasonality. So we're on that tail end of that seasonality. So on a seasonal basis, we should be going up. But I mean, I expect we're going to end up back at 20 again, right? For the median. So we're headed back that direction. If you look at the average, so the average we're at 19. We were sitting in the 50, 60 range. So I mean, houses don't sell in a weekend. That's not normal. And we're returning to the normal where it might be 30 or 60 days to sell your house. Now, again, the median should be about 20. So what that's telling me is if you haven't sold in 3 weeks, the market's probably telling you your price too high. Again, depends on the exact product, if it's unique. But we're headed higher on this number as well. But look at months of supply. So months of supply, normal, 4 months is, most people would deem it a seller's market. I think that's on the edge of being a neutral market, but 4 to 6 months being a normal market. So we were sitting there for years, around 4 months of inventory. We got down to 0.7 at the beginning of the year. We got up to 1.6 in July. We're back down to 1.5. So 1.5 historically, and again, I want to put perspective, 1.5 months of inventory. We were at 17 months in the recession. So anybody who thinks we're in a bubble, I'm not sure they existed back in here, or were they paying attention in here? Because 1.5 months of inventory is not like 17, right? And the fastest we got was 3 months of inventory in pre-recession. So that's as fast as we were. And again, months of supply, the best way to explain that to clients, I find, is at 3 months of supply where we were in 2005, if there were 3 listings, one of those would sell that month. In the recession, if there were 17 listings, one of those would sell. In the spring of this year, pretty much for every listing, it would probably sell. Now we're about 1.5. So we're still twice as fast on sales as we were pre-recession. So anybody who thinks this is a slow market doesn't have the perspective of where we were back in here and even back in here. We are still twice as fast as we were pre-recession. So just want to put that perspective in for everybody. And also, if you zoom in, it's very interesting to watch, how this kind of peaked out. Look what happened last spring, fall, right? We kind of got up to 1.2, and then we started falling into the winter again. I'm not saying we're going back down to 0.7 months of inventory, but let's keep an eye on this. And months of supply is directly a correlation of homes for sale and closed sales, right? So let's look at the homes for sale. So here's the homes for sale, and look at the last month, right? And again, I don't necessarily agree with these market monitor numbers, but the general trend is it definitely has leveled out in August. We were on this upward trend, but you look at that calendar and it is definitely leveling out in August, but that's the normal seasonality, right? If we go back in time, you can see the seasonality trend every year. And what we're doing is, this was non-seasonal. This was a market condition, but now we're starting to see seasonality back into the market. And I feel like this is part of the seasonality, right? School started, right? So how many sellers are really excited to sell their house the moment their kids go into school? Not as many, right? So our sellers are becoming less motivated, which again, it's a challenge on our end, but the seller, which is keeping the supply from going too high. And again, everybody who says, oh, are we in this bubble? We have 2,600, 2,700 homes for sale. We had 6,000 pre-COVID. So we're still less than half of what we had pre-COVID. And in my mind, we need 6,000 homes for sale to have a balanced market. If you go back in time, we had 12,000 homes for sale in 2007. So here we are 15 years later with 2,600 homes for sale and 50% more people living here, right? So I just want to put a perspective of anybody who says we're in this market that can go down 20 or 30%. Well, this is why that happened. We had 12,000 homes for sale, right? And in the other combination, so we have, just for perspective, we have around, just to be easy, 2,700 homes for sale. Now let's look at the demand side. So the demand side is your closings. And we'll zoom in again. So here's our closings. So 1,600 sales, just to be easy number, that's off 26%. So compared to last August, we have 26% less closings, right? So that's showing the demand slowing down. However, it's hard to sell 2,000 houses when in the spring we had 1,000 houses for sale. So this is driven by more than just the slower demand, it's a lack of supply. So you can see where the peaks were in 2020 and 2021, and where our peak was is lower this year. But it's lower this year partially because there was 928 homes for sale in the spring. You can't sell 2,000 houses with that few for sale. So I also want to put in perspective, look at 19, right? We peaked out, it looks very much like 19, right? Where our peak was. And if we go back in time, I also want to put, back here in the recession, I mean, we had some months where we closed 400 homes, right? And we had 12,000 for sale. So how prices go down is you have 450 homes selling a month and you have 12,000 for sale. We're selling 1,600 a month with 2,600 for sale. That doesn't sound like a bubble to me. So again, it's all relative comparisons from time, and we still look very much like a seller's market. It just doesn't feel like a hyper seller's market. New listings. So we're off 16% on new listings. So we're not listing as many properties, which is also controlling the supply. And you can, and this is the one chart, it doesn't look any different with COVID, right? So there's still not enough motivated sellers out there to cause a problem. Here's pending sales. So off 13% from a year ago. But again, if you look at the chart, it looks like 19 and it looks like 18. It just doesn't look like 2020 or 2021. Here's the dollar volume. So we're off 14%. But again, that's just because we're not closing as many sales and we just don't have as much inventory. Shows to pending. So, we're sitting about 9 showings to go to pending. Shows per listing. You were about 6. So that's a lot less than we were in the spring. But again, that's a factor of lower demand and more availability. Excuse me. So, all in all, when you look at the market, there's really not the signs of major challenges. So from a perspective of sharing with your buyers and sellers, sorry, I got a frog in my throat. So when you look at the challenges, it's not on the supply side. There's not enough sellers out there. It's more on the demand side. It's affordability. The higher interest rates, higher prices, it's less affordable. So, it's all individual discussions with your clients. and just make sure that those conversations you have, use the data. Don't leave it up to the media. You have to be in front of them and look at numbers like this. Any questions out there so far? Let me look at that chat real quick. So I wanted to also to put in perspective of the different markets. Let me move this real quick. So you can also look at, if you look at vacant land. So here's where our vacant land has been. So we had 1,600 pre-recession for sale. This is land for sale, forget the homes. So 1,600. We went up to 5,000 lots for sale. So it took years to work that off. And then we're down to 1,000. So, we have the same challenges with vacant lots, is there's just not many lots for sale. And when you look at the closed sales, it was the same thing. So we got down to, we were only selling 25, 30 lots a month. And then we got back up, and in the middle of the pandemic, we're selling 200. So yes, our sales are off on vacant land, but it's the same challenges. If you don't have enough for sale, it's hard to make those closings happen. And if you look at sales price, what's interesting on the vacant lots, there's a certain cap on there. It's really hard to see much of a change. When we went from 200 to 260, but that's still below where we were, during the recession. And I think part of what you're seeing is that the cost in construction is also a factor on how much people are willing to pay for lots. Because the more expensive the lots are, then it's hard to pay too much based off the construction prices these days. And if we look at, let me go back off the vacant land. If we go back to residential, so here's again the entire, what do we have, 18 years of data, and look at the change in the slope, and we'll just do some math here. So let's start from May of 2020 to today. We've gone from 370 to 535. And this is rolling 12 months. So 535. So I mean, we've gone about 45% higher since COVID. So if you look at the market as a whole in Charleston, that's 45% appreciation in 2.5 years, less than 2.5 years. And the level of appreciation, let's go from 2012. So beginning of 12, we were at 251. And let's just go the beginning of 20. We were at 367. So we went 46% in 8 years. So that's roughly about 5%. So pre-COVID, we were going up 5% a year. So that's a very sustainable long-term trend that the market has shown. And if you look at the US as a whole, if you go back, I think it's almost 50 years, the median price has gone up about 5% a year for 50 years. I think it's like 4.6, 4.7. So this run up is, 45% in a little over 2 years. That's not the way the market can sustain itself long term. I don't expect us to kind of go and head down. I feel like we're going to go meet where we should be long term, somewhere, slowing down on appreciation. And sure, it certainly could get below 5%, on appreciation, but it's still, you're not going to have this problem unless we run into a supply problem. When you think about it, 12,000 homes for sale, I don't think we're going to hit 6,000. I don't think we're going to hit 6,000 next year. Because I just want to put a perspective of, when I was looking a year ago, we have about, compared to a year ago, we have about 35% more for sale today. So let's get rid of the rolling average. So if we're at 2689 and we go up another 35% next year, so next year, are we at 3630? This time of year, maybe higher, but are we going to be at 6,000? I just don't see where the inventory is going to come from, because you've got a problem with 90% of the US that has an existing mortgage. Their mortgage rate is lower than the current rate. So their motivation to become a seller, which is his home for sale, is very low. So at the same time, even if the demand is slowing down, the supply is going to slow down. And you cannot, prices are sustainable unless you have an imbalance like we had in here. And if you look at months of supply, most people use 6 months as the dividing line between a seller's market and a buyer's market. So if that is the dividing line, you can see from July of 2006 all the way to almost September of 2013 would be termed a buyer's market. Now, I'm not real worried about prices until you get to maybe 8 months of inventory. then you start running a risk of lower, prices. Because what's going to happen is, so just think about it. If you have 17 sellers in May of 2009, you have one buyer that 17 sellers are competing for. And the only thing they can really do, sure, they can, clean up their house, they can stage it, they can paint it, they can do all that stuff. But the only other thing you can do is lower your price. When you have 17 people competing for one buyer, what do? They lower their price. And even if all 17 don't do it, some of them are, and it creates this trend where that's what happened with prices until we became into a more neutral market. Because if you look at where the prices happen, so our peak inventory, if I'm looking monthly, our peak inventory or peak supply and demand was May of 2009. So if you look at prices, let's look at prices. So May of 2009 was right in here, and look where the low was. The low happened after that, right? So from May, roughly 2009, 10, 11, and I had a hard time, but look at where the trend started to go higher, and maybe we can see it a little bit better with the rolling 12 months, right? So we started going down into 2009, 10, 11, and look at where it started going back up is right at the beginning of 2012, right? So 2012 prices started going up 5% a year again. And if we go back to the months of supply, and we go to 2012, we were getting below 10 months of inventory, right? So even the market is showing us in here, prices were going up, right? So even at 9, 10 months of inventory, prices were going up on the back side, right? So once we were heading this direction, prices started going up. If you look at, again, if we go back to the prices stopped going up roughly, because I mean, this is mostly sideways. After you reach May of 2006, the price is mostly sideways, right? So if we look at months of supply, May of 2006 was right here, right? So as we were crossing through 6, 8, 9 months of inventory very quickly, the prices started stagnating, and then they started to go down. And then after that, once we're on this slope, so I mean, prices really didn't do much on the way up, started going sideways. And then once you get above a certain level, they started going down. We are so far below that level. I mean, even if we look at monthly here, right, we're at 1.5. We're nowhere close to even 6 months of inventory. And where, projecting where the market's headed. Okay, like if we look at homes for sale, I think the market is going to get back to this level here where we have 6,000 houses for sale, and you're going to see builders not do what they did back here, right? They're not going to overbuild without having an end user buyer, which was what was happening back here. And you had a lot of fake buyers who were never going to live in the house. That's not going to happen this time. And if we return, let's say we return to 6,000 level, right? If we have 6,000 listings and we get back to, and just to flatten this out, 18,000 sales in a year. Remember, this is rolling 12 months. That's 1,500 home sales a month. So if we go back to 1,500 and we have 6,000 for sale, that's 4 months of inventory. That is still a market that can appreciate over the long term. So this is, again, this is a rolling 12 months, but look, we were sitting around 18,000 houses a year for sale for years. And then all of a sudden we went up to 24,000, almost 25,000. So remember, the peak was June of 2021 was the peak 12-month rolling period. And then look what's happened. We're dropping off. And where are we going to drop off to? I feel like we're going to drop back off to this level here. So we're going to go back to where we were in 2019, which is, roughly 1,500 home sales a month and 6,000 for sale, which when you look at the months of inventory is right around 4, which was an appreciating market. So, and again, I think the builders are smart enough from back here. They're not going to overbuild, and you're going to have, enough data and information that they're not going to put too many specs out there without having a buyer to it. And when you look at, and again, I know forecasts are hard. I read an article this week that Fannie Mae is forecasting the average rate in 2023 to be 4.5% on a mortgage. Well, it's a little surprising, right? Because that's lower than where we are at today. And I'm not saying they're right, but I think that also shows that, hopefully we're in the upper range of where mortgage rates are going to be. And you gotta remember, even if the Fed raises rates, that doesn't necessarily mean the mortgage rates will instantly change by that 0.5% or 0.75%. It's probably already priced into the market. So, hopefully we're on this upper end of the mortgage range because we can't slow down the supply. Sorry, we can't slow down the demand too much. Otherwise then we might create an issue, having too little demand for the supply that's out there. So again, I think it's important to read, some of these articles that are out there, but also understand that you have to be able to translate it for your clients, buyers and sellers, into the real world, what's happening in our area. So, use Market Monitor. And again, they only update the data once a month. So, this comes out, basically on the first of the month. You can look and see what the changes are, and you can get a feel for where everything's headed. But I think this is a good example of the reality might not match like some of these extreme articles that you read, and watch out in the future, because again, if I'm a betting person and if I look at, median price of 425 in May of 2022, and I'll mark it on my calendar, I just don't know if we're gonna be at 425 in May of 2023. So you have some maybe media outlets that are going to pounce in June when they get the numbers and say, look, housing's down 5 or 10%. But what matters in the long run is watching this supply and demand. If you only watch one number, the months of supply is the important thing, because that is a combination of the supply and demand. And again, historically, we're as low as we've ever been. If you look at even pre-recession, we're half of that. So we can't be in this high risk of price decline when you have 1.5 months of inventory. And if you zoom in, like, let's watch the next couple months. I think with the supply slowing down, I think we are seeing this seasonality return. And do we go back down through into the winter? Maybe so. Look at the pending sales, right? The pending sales were up from last month, right? So we had 1528 pending in July, 1748. So it shows the demand actually increased, whereas the supply decreased, right? So that's a very interesting August change to see what carries over into September and October. I think part of the pending sales is partially because of that drop in interest rates for a period of time. I think some buyers that were on the sidelines jumped in. But and again, typically we hit our low in the winter, right? Look at December, 1,000, 1,500. And again, this is COVID time, but if we go back, let's look in December's. I mean, we had 1,006, 1,100, 11, 1,200, 1,000. So we're still good chance we might end up above the range that we were in here with pending sales. So still less homes for sale, more under contract. That's still showing we're in a very healthy market. It's just a changing market. So does anybody have any comments, questions, anything they want to add? And you can take yourself off of mute or put it in the chat if you want. So I encourage you, again, in my office, I have on my calendar what the inventory is every morning, just so I can follow these trends. And I mean, I knew August was a slowdown in supply before these numbers came out, because I can see it on my wall calendar. But I encourage you to, once a month, even if you can't get on this call, is just go into Market Monitor and go through these 12 tabs and see what's happening, and be able to convey that to your client. And if you have some nervous clients, whether they're buyers or sellers, point out times of reference of, this is not a recessionary period. We don't have 12,000 homes for sale. There's still an under supply and still very high demand. It's just not quite like what it was 6 months ago. But it's this transition that makes it feel different, but it's still a very healthy market. So, well, I hope that was some useful information for everybody, and everybody enjoys a long weekend and maybe sells a house or two along the way. But we'll do this again the first Friday of next month, and I'm always around the office if you want to stop by. So, all right, everybody, have a good weekend, and be safe out there. Oh, wait, there's one chat. Oh, just a thanks. You're welcome. Bye.
Thanks, Anton.
You're welcome.